I want to talk to you about something that's accelerating right now in December 2025, something so strategically significant that it represents the most serious challenge to American financial power in 50 years. And yet, if you're following mainstream news, you're probably not hearing about it with the urgency it deserves. There are no emergency broadcasts, no presidential addresses, no primetime specials explaining what's at stake. The coverage is sporadic, technical, buried in the business pages. But behind closed doors in Washington, in the Treasury Department, at the Federal Reserve, in the Pentagon's strategic planning offices, in the transition teams preparing for the new administration, there is something close to panic, quiet panic, controlled panic, but panic nonetheless. China has successfully operationalized a dollar-free oil contract. Not a pilot program, not an experiment, a fully functional, rapidly expanding mechanism for buying and selling oil without using US dollars. And major producers, Saudi Arabia, Russia, Iran, Iraq, the UAE, even Venezuela, are using it at scale. This isn't theoretical anymore. This isn't some distant future scenario that analysts debate. This is happening right now, processing billions of dollars worth of transactions monthly, moving millions of barrels of oil, settling in yuan instead of dollars. And if you understand how American power actually works, you'll realize this is the beginning of the end of an era. Here's the question that should keep every American policymaker awake at night. What happens when the commodity that made the dollar indispensable to the global economy, oil, can be bought and sold without dollars? What happens when the petrodollar system, the foundation of American financial dominance for half a century, simply gets bypassed? What happens when the world's largest energy importer and the world's major energy producers decide they don't need Washington's permission to do business? It's a perfectly valid question to ask. After all, the petrodollar has seemed permanent, almost natural, like gravity. For 50 years, if you wanted to buy oil, you needed dollars. It didn't matter if you were Japan, Germany, China, or Brazil, you first had to acquire U.S. currency. This created permanent, structural, insatiable demand for dollars worldwide. It's what allowed America to print money that the world was forced to accept. It's what enabled us to run trillion-dollar trade deficits without suffering currency collapse. It's what made financial sanctions, cutting countries off from the dollar system, such a devastating weapon. That system is now under direct coordinated assault, and the assault is systematic, sophisticated, and accelerating faster than most people realize. So let me walk you through what's actually happening, because once you understand the architecture China has built and how rapidly it's scaling, you'll realize this isn't a future threat that policymakers can prepare for. This is a present reality that's already reshaping global power dynamics. And I should warn you, once you see how far this has progressed by late 2025, you'll understand why there's quiet panic in Washington, because they see it too, and they're realizing they may have already lost the ability to stop it. Let's start with the mechanism itself, because this is brilliantly designed. It's not just one contract or one agreement. It's a comprehensive ecosystem that China has been building methodically since launching the Shanghai Petroleum and Natural Gas Exchange's yuan-denominated oil futures contract back in 2018. But what seemed like a minor regional alternative back then has, by December 2025, become a genuine rival to the dollar-based system centered in New York and London. Here's how it works in practice. The Shanghai International Energy Exchange, INE, now offers crude oil futures contracts denominated entirely in yuan. These aren't obscure financial instruments that nobody uses. In 2025, the contract has achieved something remarkable. It's become the third most traded oil futures contract globally, after Brent and WTI. Daily trading volume has exceeded 400,000 contracts on peak days, representing over 40 million barrels of oil. That's real liquidity. That's a functioning market. But the genius isn't just the contract itself. It's the infrastructure China built around it to make it functional for countries that don't want to hold massive yuan reserves. This is where the panic in Washington originates, because China solved the fundamental problem that prevented previous challenges to dollar dominance, convertibility, and trust. Here's the problem every alternative reserve currency faces. Countries need dollars not because they love America, but because dollars are liquid, stable, and universally accepted. If you're Saudi Arabia and someone pays you in Brazilian reais, what do you do with reais? You can't buy German machinery with them. You can't pay your workers with them. You have to convert them to dollars or euros, which defeats the purpose. This is why the dollar remained dominant even when countries resented American power. There was no practical alternative. China solved this through gold convertibility. On the Shanghai Gold Exchange, yuan can be converted directly to physical gold at any time. So if you're a Saudi oil company and China pays you in yuan, you have three options. Hold the yuan and use them to buy Chinese goods, technology, or infrastructure. Invest the yuan in Chinese financial markets, which are now the world's second largest, or convert the yuan to gold on the Shanghai Gold Exchange and hold a physical asset that's universally valuable. Think about what this means. You can now sell oil, receive yuan, and immediately convert to gold if you want. No dollars involved anywhere in the transaction. The yuan isn't just a currency in this system. It's a claim on either Chinese goods or physical gold. That makes it functional as a payment mechanism, even for countries that don't fully trust Chinese currency stability. By late 2025, the scale of this system has become impossible to ignore. Saudi Arabia, which let its 50-year petrodollar agreement with the United States expire in June 2024, is now settling approximately 25% of its oil exports to China in yuan. That's not 25% of a small amount. China is Saudi Arabia's largest customer, importing roughly 1.8 million barrels daily from the kingdom. At current prices around $75 per barrel, we're talking about $135 million daily, or nearly $50 billion annually, in oil transactions that have exited the dollar system from this single bilateral relationship alone. Russia, completely cut off from dollar markets by sanctions, now conducts essentially 100% of its oil and gas trade with Asia in non-dollar currencies. Russian oil to China, settled in yuan and rubles. Russian oil to India, settled in rupees and dirhams through elaborate currency swap arrangements. Russian gas to China via the Power of Siberia pipeline, yuan. Russia has effectively been forced to pioneer the dollar-free energy trade, and they've proven it works. Russian oil exports to China reached record levels in 2025, over 2 million barrels per day, and not a single dollar changed hands. Iran, under sanctions for years, has been selling oil to China in yuan since 2019, but the scale has expanded dramatically. In 2025, Iranian exports to China exceeded 1.5 million barrels per day, virtually all settled in yuan. Iran takes those yuan and uses them to buy Chinese machinery, technology, consumer goods, and infrastructure development. It's a closed-loop system that completely bypasses Western finance. Iraq, historically one of America's closest Middle Eastern partners after the 2003 invasion, announced in late 2024 that it would begin accepting yuan for oil sales to China. By December 2025, roughly 15% of Iraqi oil exports are settled in yuan. The United Arab Emirates has established yuan clearinghouses and is facilitating yuan-denominated oil transactions through Dubai's financial infrastructure. Even countries without sanctions pressure are choosing this option. Venezuela, desperate for revenue under U.S. sanctions, is selling oil to China and receiving payment in yuan. The transactions are processed through systems that completely bypass SWIFT and Western banks. Kuwait and Oman are exploring yuan settlement options. Indonesia, a major LNG exporter, is discussing yuan pricing for natural gas exports to China. Now, let me tell you why this creates panic in Washington. It's not just about losing market share or prestige. It's about the fundamental mechanics of American power and prosperity unraveling. The petrodollar system, formalized with Saudi Arabia in 1974 after the gold standard collapsed, created permanent structural demand for dollars. Every country needed dollars to buy oil. This meant countries ran trade surpluses with the U.S. to earn dollars, or they borrowed dollars, or they sold goods and services for dollars. The dollars accumulated in central banks as reserves, and those reserves were invested back into U.S. Treasury bonds, financing American government spending. This circular flow, dollars go out to buy goods, dollars come back to buy treasuries, allowed the United States to run enormous deficits without consequence. We could import far more than we export because the world needed dollars regardless. We could borrow trillions at low interest rates because foreign central banks had to park their dollar reserves somewhere safe. We could print money without triggering inflation because the world absorbed those dollars as reserves. The numbers are staggering. The U.S. trade deficit in goods is roughly $1 trillion annually. We consume about $1 trillion more in physical goods than we produce. In normal economic circumstances, this would cause catastrophic currency depreciation. The dollar would collapse, imports would become unaffordable, living standards would plummet. But it doesn't happen because of dollar dominance. The world needs our currency, so they'll accept it as payment, even for massive trade imbalances. But here's the vicious cycle that's beginning. As oil trades increasingly in yuan, global dollar demand falls. As dollar demand falls, foreign central banks need fewer dollar reserves. As they need fewer reserves, they buy fewer treasury bonds. As treasury demand falls, interest rates must rise to attract buyers. As interest rates rise, U.S. debt service costs explode. The United States currently pays over $1 trillion annually just in interest on $36 trillion in national debt. That's with historically low rates. If rates rise even 1 to 2 percentage points because foreign buyers are absent, interest costs could reach $1.5 trillion, potentially $2 trillion annually. That's money that can't be spent on defense, infrastructure, education, or healthcare. It's just interest payments to bondholders, and it creates a death spiral. Higher interest costs increase deficits, which require more borrowing, which requires even higher rates to attract buyers. The scale of China's oil imports makes this especially threatening. China imports roughly 11 million barrels of oil per day, about 4 billion barrels annually. At $75 per barrel, that's $300 billion in annual oil purchases. If 30% of that shifts to yuan settlement by 2027, and current trends suggest it will, that's $90 billion in annual transactions exiting the dollar system from Chinese oil imports alone. Add India's oil imports increasingly settled in rupees, Southeast Asian countries exploring non-dollar options, and you're looking at potentially $200–300 billion annually in reduced dollar demand just from energy markets. But the threat extends beyond just the transactions themselves. It's about what happens to the yuan that accumulates in oil-producing countries. This is where China's broader strategy becomes visible, and it's sophisticated. Oil producers receiving yuan face a choice. What do we do with this currency? China has systematically created attractive options. First, buy Chinese goods. Saudi Arabia's Vision 2030 requires massive infrastructure development, smart cities, transportation networks, renewable energy projects. Chinese companies can build all of it, and they'll happily accept yuan as payment. The UAE is buying Chinese electric vehicles, solar panels, and 5G technology with yuan. This creates a closed loop where yuan flows out for oil and flows back in for goods and services. Second, invest in Chinese financial markets. China has opened its bond and equity markets to foreign investors. Saudi Arabia's Public Investment Fund has invested billions in Chinese companies. The Abu Dhabi Investment Authority holds substantial Chinese assets. As China's economy is now fully open to Gulf capital, yuan earned from oil sales can be invested for returns, just like petrodollar recycling into treasury bonds, but in Chinese markets instead. Third, and this is crucial, Fund Belt and Road Initiative projects. China offers oil producers an attractive deal. We'll pay you in yuan for oil, and you can invest those yuan in BRI infrastructure projects in your own region or in third countries, earning returns while building connectivity that benefits everyone. Saudi Arabia is using yuan to co-finance BRI projects in Africa and Central Asia. It's brilliant. China gets oil, producers get infrastructure and returns, and yuan circulation expands geographically. Fourth, convert to gold. The Shanghai Gold Exchange provides immediate liquidity to convert yuan to physical gold. In 2025, trading volumes on the SGE have surged, reflecting oil producers hedging yuan exposure through gold. Central banks in the Middle East have dramatically increased gold reserves. Saudi Arabia, UAE, Qatar, all buying at record levels. Some of this is yuan conversion. This infrastructure, goods markets, financial markets, infrastructure investment, gold convertibility is what makes the yuan for oil system functional. China learned from history. Previous challenges to dollar dominance failed because alternatives weren't credible or liquid. The yuan system is both, and it's scaling rapidly. Now let's talk about what's happening behind closed doors in Washington, because the response reveals how seriously this is being taken. In classified briefings to congressional committees throughout 2025, Treasury officials have outlined scenarios for dollar depreciation if petrodollar erosion continues. The Federal Reserve has conducted stress tests on what happens to U.S. financial markets if foreign Treasury demand drops significantly. The Pentagon's Strategic Studies Group has war-gamed economic security scenarios where America's ability to finance defense spending is constrained by loss of currency dominance. These aren't public discussions, but they're happening, and the conclusions are alarming. The United States has limited ability to stop this shift through conventional policy tools. We can't force Saudi Arabia to accept only dollars. They're a sovereign nation making economic decisions. We can't sanction China for offering yuan-denominated contracts. That would devastate American companies that depend on Chinese trade. We can't prevent other countries from choosing yuan settlement. That would only accelerate the shift by confirming that the dollar is a weapon, not a neutral medium of exchange. The policy options being discussed are all variations of damage control. Maintain confidence in the dollar through responsible fiscal policy, difficult given $36 trillion in debt and deep partisan divides. Keep interest rates attractive to foreign investors, but not so high that they crush the domestic economy. Attempt to negotiate with Saudi Arabia and other producers to maintain some dollar pricing, but we have less leverage after letting the petrodollar agreement expire, and develop U.S. alternatives like a digital dollar, but we're years behind China's digital yuan in development. There's also discussion of more aggressive options, using national security arguments to pressure allies not to participate in yuan oil markets, threatening sanctions on financial institutions that facilitate dollar alternatives, restricting U.S. technology exports to countries that shift away from dollars. But these are desperate measures that could backfire spectacularly, accelerating the very trend they're meant to stop. Here's what keeps me awake at night. We did this to ourselves. The weaponization of the dollar, freezing Russian reserves, cutting countries from SWIFT, imposing secondary sanctions that punish even non-U.S. entities, taught the world that dollar dependence is a vulnerability. We turned the dollar from a neutral global public good into an instrument of coercion, and we gave countries an incentive to build alternatives. China saw the opportunity and seized it. They built the infrastructure patiently over years. They made the yuan convertible to gold. They opened their markets to petrodollar recycling. They offered Belt and Road as an investment outlet. They waited for the U.S. to overplay its hand with sanctions. And when Russia was cut from dollar markets, when the petrodollar agreement expired, when Middle Eastern countries started questioning their dollar dependence, China's alternative was ready and waiting. By December 2025, that alternative is no longer theoretical. It's operational at scale. Approximately 18-20% of global oil trade now settles in yuan, up from virtually zero 5 years ago. If the current trajectory continues, that could reach 30-35% by 2027, 40-50% by 2030. At that point, the petrodollar isn't dominant. It's one option among several, and American financial power is fundamentally diminished. The consequences cascade. Lower dollar demand means persistent depreciation pressure. The trade deficit becomes unsustainable. Imports become expensive, hitting American consumers hard. Inflation pressures build. The Federal Reserve faces an impossible choice. Raise rates to support the dollar but crash the economy, or keep rates low and accept currency depreciation. Either path is painful. Foreign policy becomes constrained. The ability to sanction becomes less effective as countries have alternative payment systems. The ability to fund military operations globally becomes limited as deficits become harder to finance. Allies become less responsive to American preferences as economic interdependence weakens. The unipolar moment, the brief period after the Cold War when American power was unmatched, ends definitively. So to return to our original question, what happens when oil can be bought and sold without dollars? We're finding out in real time in December 2025. And the answer is American power diminishes in ways both subtle and profound. Not catastrophically, not overnight, but steadily, measurably, perhaps irreversibly. China's dollar-free oil contract isn't just a financial instrument. It's a revolution in how global power operates. For 50 years, controlling the currency of energy trade gave America unmatched influence. That control is slipping away, barrel by barrel, contract by contract, yuan by yuan. The question isn't whether this shift will continue. The infrastructure is built, the participants are committed, the incentives are aligned. The question is whether American policymakers will adapt to a world where we're influential but not dominant, where the dollar is important but not indispensable, where power is shared rather than concentrated. I don't have all the answers, but I know this: the panic in Washington is justified because they're watching the foundation of American economic dominance erode in real time. And they're realizing that the policy choices that led here, the weaponization of finance, the neglect of allies' concerns, the assumption of permanent primacy, have consequences. We're living through those consequences now. The petrodollar era is ending. A new system is emerging, and America is no longer writing all the rules. The only question is whether we'll adapt gracefully or resist until crisis forces change upon us. December 2025 may be remembered as the moment when the shift became irreversible. We're living through history, and this time we're not the ones making it.